This is the Portfolio Coach Podcast, featuring Derek Davis, founder and CEO of Portfolio Coach. For more than 30 years, Derek and his wife Jennifer have been coaching their high net worth clients to financial prosperity.
Hey, Derek, it's good to have you back. Welcome, everybody. This is the June 17th, 2022 edition of the Portfolio Coach Podcast. And I'm joined by Derek Davis, founder and CEO of Portfolio Coach. And today, Derek, let's talk about what is Portfolio Coach, and not in the context of, okay, it's an application on the computer that I can use to make millions. What is it to you? What is Portfolio Coach to you?
You know, Portfolio Coach to me is my opportunity to give back, I guess, to the smaller investor and help them out. We've been doing this for over 30 years and we've helped the rich get richer, but we really want to get out there and help the little guy. Professional investors like ourselves are constantly doing trades and we do not believe in buy and hold, because basically you're going to give back all of your gains during a market correction. What Portfolio Coach does is takes our algorithm and moves it over and gives you the trades. And so on a weekly basis, you'll be allowed to have those trades and make them in your own brokerage account. We don't manage your money because you don't need to pay anybody a fee right now when you're just getting started and you need to grow your assets. And what we do is basically try to protect you on the downside, so you can make more money on the upside. If you lose less, you end up making more. So that's what Portfolio Coach is our effort to, just to give back to society. We've done very well, and now hopefully we can make a difference.
So thank you, Derek. So at the risk of insulting your intelligence, using a lot of market words, using a lot of industry words, that for those of us that have been around the market for a long time, we get it. We understand what you mean by upside, downside, portfolio, market trends, all of those kinds of things, buy and hold. Let's dive in a little bit more. Okay. I mean, let's take this from the context. I'm a 19-year-old sophomore in college. I got scholarships and I got a little money in my pocket, or I took a class at school about investing and it really piqued my interest. I don't have a portfolio big enough to have you and Jennifer manage my money and make me richer. Bring it down to my level a little bit. When you talk about buy and hold versus active trading, let's break that down a little bit. And then we'll break down upside, downside, and we'll get into some of why Portfolio Coach makes a difference for me with the cash that I have. So yeah, let's talk a little bit. Let's elaborate. Let's put in the mind of let's say someone who's maybe not that college example. Let's talk about somebody who's in their first job. They got a 401k at work, but that's going to grow slowly because they're maybe taking the smallest percentage of their salary out for that. I'm not really thinking about my retirement boat down in San Diego. I'm really thinking about, like, how do I actively build some wealth now? And I think that's where Portfolio Coach really fits in. One niche, it's not the only customer it serves, but that's one. Let's start from that perspective.
Yeah. So, I guess as a first-time investor, you have limited funds. And so you're going to have a hard time getting professional customized help. With Portfolio Coach, you can go on and you can pick out your own customized portfolio that we've built for you. We've had our analysts go in and pick stocks that go onto the team. A basic team has 10 stocks. Those 10 stocks have a 10% allocation. So if you had $1,000 and Tesla happened to be one of your stocks in your portfolio, you would buy $100 worth of Tesla. And Tesla goes up to 1,200 and you do really well. And then, the momentum on Tesla starts going down. And so we would send you a sell signal and you would sell Tesla. Now, Tesla's still part of the model, but we're just waiting for it to correct before we buy back in. Now, Tesla's down at $600. hey, it looks like it's bottoming. We'll send you a buy signal. You'll buy back in. You just saved yourself $50 out of your $100, or even more so than that, because you made money. $100 in Tesla became $300, and now if you would have bought and held Tesla and not actively sold it, then you would have lost $150. So you would have given up a lot of those gains. We just don't want you to give up those gains. They're too hard to come by, and in the long run, you need those gains to build a nice nest egg for you and your family. So that's what we're there to do.
It's interesting that you bring that to light. You're talking about $50. $50 could be $300. It could be $150, and that doesn't sound like a lot of money, especially with inflation, what it is today. I mean, $150 is a tank of gas for some people, right? But you think about when we're talking about the millions or hundreds of thousands, right? So these intelligent strategies work not only at the small incremental level if you're just getting started, but it's that same concept that's helped you make millionaires, multimillionaires.
Certainly, it's exactly the same strategy. And when you start out, you may not have millions to start out, so we got to help you try to get there. You can't perhaps afford a share of Tesla at $600 or $1,200. So you're going to be buying fractional shares to kind of start out with if you have a smaller account, and then grow it hopefully into a full share and go from there.
So there's an important point you're making there on this fractional share buying. So some of you may know, some of you may not know what that's all about. There's brokerages out there. Like let's take Robinhood for an example. I'm not saying this is the only one, and this is not a promo for them, but with whatever money you have, you can buy a portion of a company as opposed to having to go in and buy 100 shares of Tesla at $600. You can come in with $100. You can come in with $200. You can come in with $1,000 and utilize these important trading signals that you're talking about to start to build wealth even at a small level, right?
Right. Yeah, because you need to get that balanced allocations. The models are built on 10 portfolios at 10%. You may be able to afford a share of a $10 stock, but it becomes more difficult to afford a share of a $2,000 stock. So the fractional shares all work out so that you hold the same dollar amount of each share versus one share of Home Depot is going to be different than one share of Amazon.
So thanks for continuing on that. You talk about upside, you talk about downside, you talk about protecting. I think sometimes that's a word in the financial markets that gets overused and inauthentically sometimes. When people talk about protecting your wealth, they're getting money on every trade. They're a broker they're getting a piece of every transaction that you do. So for them, whether you buy or sell, and especially if they're an active trading portfolio, if they're buying and selling, they're getting paid up and down all the time on the transaction. Talk to me. Let's talk about how you're protecting by upside and downside active portfolio management. And let's start at the point of on a weekly basis, what should my behavior be as a portfolio coach member?
Yeah, the key is to go to these. The key to portfolio coach actually was Robinhood. Robinhood brought in no cost trading, and what it did was it forced the Schwabs, the TD Ameritrades, the Fidelities of the world to come down off of $10 a trade down to $5 a trade, and ultimately now they're at no cost trading. Portfolio coach wouldn't work if you were being charged $10 a trade, because all of a sudden, when you need to buy Tesla or sell Tesla, you're paying $20 to get in and out of something. So here we're an RIA, registered investment advisor, and so we don't charge on the number of shares we trade, and so we don't do any commissions on that. broker dealers, which you were referring to, certainly love for you to trade, because, if they're making a dime a share and you're in and out of a stock, then that you're an ideal client for them, because they're just trying to create revenue for themselves.
So wrap this into my daily or weekly life. In order to be an ideal beneficiary of Portfolio Coach's powerful results. Now, I want to come back. We have this on our video library, and it's easy to go back and get more understanding of this. But for the purposes of our call today, the system that Portfolio Coach is built on is over 15 years of tried and true, proven trading signals that beat the market, and beat the market significantly over that time horizon. So I asked this question, and for our listeners, understand that this is successful. I mean, it's beaten the market over the time horizon that it's been tested. So you can have a high degree of confidence that if you follow the signals and you do the Portfolio Coach methodology for success, you're going to increase your wealth. But put it in context for me, Derek. Like if I'm a Portfolio Coach member and I'm really committed to taking control of my own wealth management at this stage of my life where Portfolio Coach makes sense. I don't have the portfolio that needs your expert guidance to actively manage as a RIA, and that's Registered Investment Advisor for those of you who might be new to the concept. What's a week in the life? What should I be doing to really maximize the benefits of Portfolio Coach?
Portfolio Coach was designed to actually give you your life back. My analysts and I, we're the ones that do this full time. And so basically, once you open up your brokerage account, we'll use Robinhood for an example, and you put your money in there, you go and we'll help you choose your portfolio, or you can pick your portfolio that you want to follow. And then on Saturday or Sunday, you just go log in, or we can send you a text or email if you want on the trades that we suggest you make on Monday. And then first thing Monday, you buy or sell a couple stocks typically out of the 10. Maybe you have no trades, and it'll tell you no trades. And then you don't have to, try to study the charts and the PE ratios and the everything else that, goes into our analysts are looking at constantly. What we want to do is give you your life back, and, you can look at the trades on Saturday and Sunday. If it feels right, you should do it. If you decide not to do it, it's your money. Nobody cares more about your money than yourself, although we're trying to really help you do better. So, your basic week is live your life. Our job, this is our job, is to help you do better. And you can, by just following the signals, you should. Historically, you would have done better, and hopefully, 15 years down the road, you will have done better as well.
So I know you really well, and I know that that's the real deal. I know that that's authentic, and that comes from a pure place that you really want to help others. It's sometimes like that might sound a little too good to be true for some of our newer listeners, newer members to Portfolio Coach, that it's really that simple and that you're really that devoted to helping me. What would you say to the skeptics? What would you say to those that are like, I'm not going to sign up because it sounds too good to be true, and the results charts look, they look too good to be true, and it's been my experience that anything that sounds too good to be true usually is, and it can't really be that easy. It can't really be as easy as logging in on Saturday and Sunday and setting up my trades in my portfolio or my Robinhood account and letting it go for another week. Like, it can't be that simple, right? It sounds too good to be true. What would you tell me if that's what I was feeling right now, having listened to what we've talked about so far?
The charts look the way they do because we have 15 years of returns, and instead of getting our 7% from the S&P, we're getting 15%. 15% doesn't sound a lot if you look at the Bitcoins or the Teslas of the world. over a short period of time where they rocketed higher. You're not going to get unbelievable returns from Portfolio Coach. They're going to be, they're tried and true, they're solid, they're a good number. But you're not going to get 100%, 200% gains or I've heard some guy on the radio selling this thing and it was, 5% a month. You can get 5% a month. You're not going to get 5% a month. If you get 5% a month, he wouldn't be on the radio doing ads and stuff. Our whole system is, this isn't my job or my company to make money. I have a real job and do pretty well at that. And I'm focused on that. This was built out, with my sons. I invested in some web designers to help me bring my algorithm into a friendly app, I guess, or development so that they can, we can scale it and it doesn't cost me any more time or money. And we can help, 1,000 people, 10,000 people, 100,000 people, because the trades are already built on my quant and algo that are analysts have put together, and we're helping our big clients, and you're kind of copying their trades. So it isn't, I guess it's not really costing me anything to help you. So why not? Then my son's needed, he's the one that came to me and said, hey, who's here to help the little guy? I only have $1,000. What am I supposed to do? Well, that was 6 years ago, and now he has $5,000. It's going to take time, and it's going to take some money. I can, if you have $1 and I can, it doubles every 5 years. In 5 years you'll have $2. And, that doesn't sound really exciting, but it just takes time. And if you could double your account every 5 to 6 years, in the long run, you're going to be doing a lot better. And that's what we're just trying to help people with. So I don't know that I answered your question. But we're just, it's our goal to help give back, I guess. And cover our expenses. I mean, at $20, $30 a month, we're certainly not going to get rich, but hopefully we can cover our customer service expenses of people I have to hire to answer questions for you guys. So.
No, I think you answered the question perfectly. And I think the pathway to financial prosperity is a journey. We love the stories of people that nailed it with Bitcoin. They got in super early. They exited when it was at its peak. They got lucky and didn't have to partake in the downside. And so they're rich, and or people who got in at Tesla really low and then bought a Tesla with their returns. Like, those are fun stories, and we all want those stories. But we're talking about 1% of people that you get to hit the jackpot like that. And so, the road to financial prosperity in the markets historically is a journey for people. And, you mentioned something, a 7% return. There's been periods economically in this country where people would have killed to get 7% return on their money. And the old rule of 72 came into play. Your money's going to double every 7 years if you get 12%. Or is it 6 years at 12%? I can't remember exactly.
6 years at 12%, or 10 years at 7%. Yeah.
So, I mean, think about that for a minute. $1,000 today is it with the success of Portfolio Coach's algorithm and quant, which are two really fun finance terms. The algorithm is the mathematical model that determines the quantitative analysis that tells you what to buy or sell or hold. But you take a look at that and you think there's 1,000 is 2 in 5 years, and 10,000 in 2 years is 20,000. And it doesn't take long until those duplicative gains start to really add up. And if you're a smart investor and you start at a younger age and you're wise about how you spend your money and invest your money, 25, 35, 40 years down the road with a career, and you're sitting on more than a nest egg. You're sitting on wealth that you can utilize to live your lifestyle better, invest in a startup, put back into the market, and double up again. So I think you answered the question really well.
Yeah, it really just takes returns and time. Your 10 becomes 20, and then 40, and then 80, and then 160, and then 320, and in 30 years, off of that 10,000, if you can double every 5 years, that's $500,000. So that can really help you in retirement. So Portfolio Coach wasn't built for the guy that's 60 years old that already has $1 million. He could get 2 million and 4 million, I guess, in 10 years, but it's built for the the smaller investor, and really just trying to help them out, and so that they can retire more comfortably. When they're most of our subscribers, by the time they retire, you and I won't be here, so we'll be on the other side of the dirt. So, but hopefully, we have some younger, brighter, smarter people take over for us and keep this going to really help people.
Yeah, well, I appreciate that perspective. I think back 20 years ago when I was in business school, getting my finance degree, and we thought doubling your money every 6 years, but that was as good as it got. We didn't have at the time some of these major acquisitions, these big pops that we've seen. Bitcoin obviously didn't exist. We saw the NASDAQ go up and down and crash, actually. But it's interesting to reflect on that time period and say, well, gosh, if instead of doubling every 6, if I'm doubling every 5 over a 40-year career, I actually get another 2 doubles in that number through the Portfolio Coach methodology.
Correct. And so if you would have, at the end of your doubling period, you would have at 6 years or 7 years been at $1 million. You'd be at 4 million with just getting that extra doubling every 2 years less type thing. So it works out. It just takes time and return. So we're in charge of the return. You're in charge of the time, I guess.
Well, and back to the point that you made earlier, as far as time is concerned, I mean, it sounds to me like I'm committing 10, 20, 30 minutes a week.
Yeah, no, we're trying to give your life back too. Most people that are just starting out, maybe you have kids, and those kids are just learning to walk, and now you got to chase them around the house. And, there's better things to do with your time than look at the PE ratios and the earnings and read the 10 Qs and all of that we have to do on this side. So.
Yeah, well, I'm a believer. I made a deal with my kids. We're going to wrap up this episode here, but I made a deal with my kids a month ago. It's a little tricky because 2 of them are minors, and so they can't have their own Robinhood account, but we're going to sort that out. I made a deal with my kids. If they'll finish reading one of my favorite books, which is Rich Dad, Poor Dad, and do a book report for me on the book, then I'm going to start their Robinhood account with $1,000 in it, and I'm going to pay for their Portfolio Coach membership, so that they can, in their teens, at an early age, begin to understand how, if you commit early, you stay consistent, and you have a good guide like Portfolio Coach, when they're going to be 30 years ahead of where I was.
Yeah,
they're going to be.
No, they will be. They'll be doing great.
Yeah,
and they'll be learning a lot, and they'll get up every Saturday morning when the trades come in, and they'll want to log on and see if they got any buys or sells to do. So it's a great learning platform. So.
Well, all right, Derek, that's a wrap for this one. Next time we talk about fundamentals, it's going to be a little bit more analytical. It'll be something for listeners to dive into, and so for those of you that are listening and following and subscribing, I think it's really important. I think you'll find a lot of value in that. We don't necessarily want you to feel like you're going to be coached to be a fundamentals expert, but understanding the fundamentals and why these trades are successful, why these signals work, and how that fits into market sectors. That's going to be a really important thing to listen to, because it's going to elevate your level of trust in Portfolio Coach. So Derek, it's good to talk again about these things. You know how much we enjoy. I mean, you know, I'm a nerd on these things. I just love talking about how money works and how to expand it and grow it and protect it and build it. So it's been awesome. It's been a great session today.
Hey, great catching up with you. Look forward to next time.
All right, tune in next time.
Take care. Bye-bye.
Hey, bye. Hey, everybody. Welcome back to the Portfolio Podcast, Portfolio Coach Podcast, I should say. This is Kurt, and I have Derek Davis here with us again. Derek, welcome, and it's nice to talk to you again. And today we're going to get into some interesting stuff. We're going to be a little bit heady on today's episode.
That'll be fun.
So let's jump into the idea of fundamentals today. We've talked a lot in our previous podcasts and information on the website and ads that you see on social media and otherwise about why Portfolio Coach is an easy, simple, effective, efficient way for the non-millionaire investor to grow their wealth. Whether you got $500 or you got $500,000, Portfolio Coach is a way to help you grow to the place where an RIA, a registered investment advisor firm like yours, could take their millions and make them multi-millions. But Portfolio Coach is for the average person that has a few extra bucks and wants to be smart about the way they invest their money and wants to be able to do it, maybe do it themselves because they're intrigued by it, or maybe they just need to dip their toe in the water because they don't quite know what investing is about, or maybe they're skeptical that RIAs will make more money than them. But whatever the reason, that's where Portfolio Coach comes in. But I think we got to talk about fundamentals a little bit, because the Portfolio Coach methodology, the algorithm, the quant, it actually produces really great results. 15+% returns on average over the you're beating the S&P over and over and over every year. But why? Let's talk about that a little bit today. Let's dive into the fundamentals. What is it that a person has to know? In this case, Portfolio Coach knows for you in order to be a successful investor.
Yeah, so it starts with the team, I guess. And so let's say you're from you decide to go with a fundamentally based team, and let's say it's the high beta team. What our analysts do here is we'll look for stocks that have high beta. So what is beta? So the stock market trades at a certain level. Some stocks trade much bigger, go up much faster, and go down much faster. Those have high beta. Some stocks go up much slower and go down much slower. Those stocks are low beta. So a high beta stock might be are generally focused on technology, new generation, not necessarily a lot of profitability. A low beta stock is going to be, a McDonald's, a J&J, a Home Depot. A high beta stock will be a Tesla, a Coinbase, an Upstart, a Datadog, Lemonade, all these kind of startup stocks that are growing quickly. And so those stocks tend to do very well when they start out. As far as stock price, although their PE, which is another fundamental thing we look at, which is price to earnings. So a typical stock that might have a earnings of $1 a share would trade at $15 would be their stock price. That would be a 15 times PE. And so with a 15 times PE, you're kind of right there at the low end of historical values. What has happened recently is the Netflix of the world and a couple other ones out there have gotten to a 60 or 80 times PE. So what you're going to have to do is you're going to have to wait years for their earnings to double, quadruple, even go 8 times before that, that 60 times becomes 15 or 18 to typically where we would consider that a good value. So that's kind of where we are as far as what is beta, I guess.
So you're using some insider terms there, and so let's break some of those down a little bit. You're talking about PE, which is the price to earnings ratio. Let's break that down a little bit, so that maybe if I'm a little bit new to the game, maybe if I'm just dipping my toe in the water with my first $1,000 or whatever with Portfolio Coach, let's break those down just a little bit for understanding. And one thing I want to come back to that you started with, Derek, when you're talking about teams, you're talking about how Portfolio Coach functions. The Portfolio Coach, you have a portfolio, and we call them teams, and a team consists of players. So a team is a portfolio, quote unquote, that you've heard over the years, and then the players, as if you were on a sports team or some other type of team, the players are the individual stocks. So the individual stocks within the team are what your quant and your algorithm is assessing on an active basis to tell me whether I should buy, trade, buy, sell, hold. So for those of you who are listening and not quite connecting there, remember that that's how Portfolio Coach works. You have teams that have players. Those players are actively entered or exited from the roster on a daily basis, so that when the market goes down, you don't lose as much. And when the market goes up, you get gains. So let's talk about a couple of those things. You talk about PE ratios, you talk about multiples and 8, 12, 15, and 80. Take us a little deeper on that. Why is that important? And how does Portfolio Coach solve that problem for me so that I don't have to be an expert in that in order to generate wealth from my investments?
So, let's start out at a 10,000 foot view, right? Everybody, it's the S&P 500. Okay, it has 500 stocks, so it looks at the broader market. Right now, if you add up the earnings of the S&P 500, it's real close to $200. Now, if you're going to trade at 20 times, the fair value for the S&P 500 would be 4,000. If it's trading at 16 times the 200, then it would be at 3,200. And this is actually the value of the S&P 500 when you look it up on CNBC or Yahoo Finance or Google Finance. That's the price of the S&P 500. Now, as you drill down and you look at a stock like Apple, so Apple has historically done very well, and so it has a higher PE than perhaps the average. So if a historical fair value multiplier on Apple might be $22 a share. So if Apple's making $10 a share, 22 times means Apple should be trading at $220 a share. And that would be the fair value of Apple. Whereas something like a Walmart or let's use J&J for an example, they are more consistent with their share but have less growth, so they're going to be a less multiple. So let's say they're at $15 a share. Let's say they're making the same $10 a share that Apple is making, but their multiple at 15 times is going to leave their fair price at 150. And then what our quant and algo will do is look and see when stocks are oversold or overbought, as well as the momentum as far as looking at trading volumes. And if Apple's trading at 30 times its earnings, then perhaps and there's less buyers, then perhaps we should sell it and wait for it to get back to its average. Whereas J&J is trading at 10 times. Well, historically it trades at 15 times. How are we going to get up there? Let's buy it and allow the buyers to come in and get it back to everything reverts to its mean. And we've seen that certainly in the last 6 months, probably more so than anything. There was a lot of money thrown into the system or sent out by the government, and a lot of people bought a lot of stocks, and those multiples got really high. And over the last 6 months, we've seen a retracement of 30%. And now what that means is instead of 30 times earnings, we're down 30%. So now we're at 21 times earnings. And we still need to go down to maybe 18 times earnings on a historical basis. And the NASDAQ's going to have a higher multiplier than the S&P 500, which is going to have a higher multiplier than the Dow, because those are the big, strong, big stocks that can't grow really quickly. They're not going to double their revenues next year like a Lemonade or a Datadog might do. So
they're the 100-year-old, 200-year-old companies. Yeah, those 200-year-old companies are just slower moving, right? They can only get so big so quick, and they're proven.
If they were locked into that same 15 times ratio, and they were growing their earnings at 8% a year, and they were locked into that 15%, then their stock price would grow at 8%. So that's kind of how PE works in setting the price of a stock, the fair value price of a stock.
So I've heard some people argue that PE doesn't even matter anymore. It's not even worth looking at because the PE ratios have gotten so inflated in some of these massive companies like Netflix or some people made that argument about Apple, and then they realized how much cash they had on hand, and they're like, oh, maybe it's undervalued a little, even though it has IP. So does PE matter? People are saying that the price to earnings ratio doesn't matter anymore because there's so much inflation in that value in some of these high-flying tech companies.
Yeah, I heard from a lot of those people middle of last year. We should reach out to them and see what they say this year, because the companies that were at 60 times are now at 20 times because they lost 67% of their stock price. So there are certain things that don't have that are negative, have negative earnings, and so their PE is negative at this point, which doesn't make a lot of sense. They're going to have to, those are the startup companies, and we do, invest in a lot of startup companies because they're growing so fast that they're going to grow into profitability. So, Amazon, Apple, Microsoft, Google, they didn't always make money. They all started off losing money when they went public, and then over the course of time, now they print money. They do a great job, and they have a lot of cash in their balance sheet. So
I think you've just inspired another episode of understanding how companies grow. I think it's very unknown to the average person in the population, and not because of a lack of intelligence, just because there's a certain specialty that comes from doing what you do every day, watching this every day, being in a business environment, understanding startup, understanding growth stage, understanding maturity, understanding the end of the life cycle of a business if that happens. And we love to see big pops. It's exciting. It's thrilling when a stock pops this really big price and becomes newsworthy. But there's a lot of years in those companies where they're operating at a loss. And if it wasn't for investors infusing money into the business, they couldn't survive.
Very, very true. I mean, there was, I read an article 20 years ago, probably in the 90s. Apple was going bankrupt, and Microsoft is the one that bailed them out, and that was to keep Microsoft from becoming, the only player in the game. And then Congress was going to come after Microsoft, so they wanted to have another player. So it's real interesting to, now they're, they compete against each other, and everybody thinks that Apple and Microsoft don't get along, but they were in. That's how Apple existed, I guess, during some tough times in the 90s.
Yeah, and again, that's probably a podcast for another day. But competition, right? How competition can affect share prices, how competition can affect business operations, how business operations affect profitability, how profitability affects the attractiveness of an investment, affects your PE, affects the other fundamentals. So great. So thanks for taking us through that on PE. In my finance training in college, that was the number, my mentor, that was the number one metric. And he had a strategy. He would set a cap on the Dow. And he said, and he no matter what, he had extreme discipline. It was remarkable, his discipline. Even when he knew the market was going to go higher, when it reached his cap on the Dow, he came out and he went to cash. And everybody said that he was crazy for doing that because the market he'd missed a couple of massive market run-ups. What they didn't admit to, and what they didn't have a conversation and follow-up was, when he watched that go up another 20% and everybody was buying Lamborghinis, nobody ever came to him when they were selling the Lamborghini because they lost way, way, way too much and he was in cash. So every time they came down and they lost their Lamborghini and their nice apartment in Manhattan, he just bought the share price where they were bottomed out and up he went again. Yeah. And, he was really disciplined and he understood those fundamentals really well. What are a couple of, maybe let's move to a different fundamental that's key to the algorithm, to the quant that makes Portfolio Coach work for me as a subscriber, as a user that goes in on a Saturday or a Sunday, understands which players I need to move in and out of the game by buying or selling. How does it? What are a couple other fundamentals that are critical to what you guys are doing on the inside every day to protect my wealth, grow my wealth by following your coordinating, you might say. You're my offensive coordinator. You're telling me my plays to run in and out.
Yeah, one of the things we look at is moving average. And so moving average, and you'll hear it a lot if you do any finance stuff, you'll hear about the 50-day and the 200-day moving average. And basically, over a long period of time, a stock's average is going to be, genuinely in an upward, from the bottom left to the upper right type trend. And then on a short-term basis, you look at a 50-day moving average to see what the current trend of that stock is. On a 50-day average, if it's higher than the 200-day average, the stock is going up faster than it had. If the 50-day is below the 200-day, then the stock's going down from where it historically has. So we'll look at that, but certainly not at the 50 and 200-day. We're much more active in that, so we're looking at a much shorter period of time on both sides of the thing. The other thing we really look at is trading volume. If a stock trades 1 million shares a day and it's going up $1 a day, and it's going up $1 a day, it's going up $1 a day, and all of a sudden is trading 800,000 shares or 600,000 shares or 400,000 shares, and it's going up $1 a day, 80 cents, 60 cents. It's topping out and it's rolling over. You're running out of buyers, because for every seller, there's got to be a buyer. And so as the stock is going up and you're getting less volume, then it's rolling over, and we want to sell. And then you're going to see, as the stock starts going down, you're going to see the volume go up again until it gets down toward the bottom. And then you're going to see, again, lower volume because there's going to be less sellers. And so we look at those along with moving averages and convergence, divergence, which is, taking into effect what's going on with the pricing on a tick by tick basis and such like that. But the moving averages and the trading volume really make a big difference for us as far as the quant now is concerned.
Okay, good. So we got PE, we've got moving average, we've got trading volume. What are the other things that would help me understand a little bit further? Let me restate. I think the question is, how do I trust something that I can't see? And maybe I don't understand these fundamentals. How do I trust? How do I trust that it's working? And I'm not going to let you off the hook with a simple answer like, well, I have data for 15 years that shows we're better. Yeah. More viscerally, how do I trust that, given that I might have a little nest egg and I might be risking some of my nest egg? How do I trust that? How do I put the money in, actively trade, and give my heart to that part of my money, and how it works with Portfolio Coach?
Yeah, it's hard because the subscribers are going to be looking at us for the first time or in a day or a week, and they're not going to see behind the curtain, I guess, to see the the 30 years experience that we've had doing this and the 15 years that we've been running the algo and the quant and the signals of the, I'm looking at 4,000 different signals, or not different signals, because I'm looking at 3,000 different stocks and 100 different ETFs. And the without computers, none of this could happen, because I can't analyze, those 4,000 different variables on a daily basis on what's going on each of the stocks and ETFs. The computer is self-learning. It's AI driven. But I don't know. How do I trust it? I have the experience. The first time that we did it, we questioned it a lot. There were times back in 2010, well, even 2008, after it had crashed, we got a bunch of buy signals in March of 2009. The last thing you want to do is do a bunch of buys in 2009, because the stock market's down 60%. We did it, and the program turned out to be right. And so at that point, we had a lot more trust in the program. I guess what has to happen is the subscribers, as the market's going up or down, will look at their own experiences to decide. When it says sell Apple, Microsoft, Google, Facebook, Tesla, and you're thinking, why? The market hasn't gone anything but up. But we get sell signals on that 6 months ago, and now all those stocks are down 30-40% of where they were. Now all of a sudden they're going to have more trust. So really, to go all in is going to take some time for them to trust the signals and watch what Portfolio Coach saved them from losing, I guess, more so than anything else. Everybody can make market money when the market's going up. That's the buy and hold philosophy. You buy all those stocks and you just hold on to them no matter what happens. But why participate in those losses if there's a product out there that can, is designed to help you, lose less so you'll make more? And that's what Portfolio Coach was designed to do.
It's great insight. I think that sort of hits on the idea of some of the softer fundamentals, the non-analytical, the non-mathematical signals is the idea of and I think this is a way that Portfolio Coach really protects you from yourself. And I bring it back to my mentor in my investments classes when I was in college. We spent the first 3 months of our investment training reading case studies and learning about psychology. And the remainder of the time, we spent understanding analytics. We spent time understanding fundamentals, how to trade. And then we actually traded. There was an endowment there. He gave us cash. It was a sink or swim thing. If you succeeded in your investments, you got to pass the class. If you didn't, well, better luck next year. Or you might go get a liberal arts degree or something. Not that there's anything wrong with liberal arts degrees for those of you who are listening, but my dad has one. So I'm not critiquing, but it was fascinating that what we got frustrated with in understanding psychology and behavior, Portfolio Coach helps to manage that by saying, I'm going to make it simple. If you buy now, you'll be happy. If you sell now, you'll be happy. You may not see it tomorrow. It might be a few weeks, but that 30 and 50-day moving average, the book trading volume, PE ratio, those fundamentals that tell you how the market is behaving in general, in broad brushstrokes, they protect me. They protect an individual by telling me buy, sell. And it's as simple as that. I go in on a weekly basis, buy this, sell that, hold that, and I'm protected. I'm insulated from some of those insecurity behaviors or enthusiasm behaviors that can be actually detrimental to a portfolio's success, because emotion plays a huge role in our markets.
It does. Human nature is, and it takes place even here in the office, and we just can't override the program. There's FOMO, the fear of missing out. And the fear of missing out is basically causing you to buy high. And then, you know, what we did we were having issues with in 2009 was, you know, the fear of buying in when everything looks so bad. And, you know, but the computer doesn't have emotions. It just looks at numbers, and numbers don't lie, you know, emotions do. And so, you know, you want to buy low and you want to sell high, but human nature is, you know, buy high and sell low, because you want to go into protection when you're at the bottom, and you want to buy because everybody's making money at the top. And that's exactly the opposite of what you should do. And the computer takes the emotions out. So our signals are emotion free, I guess, which is a great thing to have.
You know, on that point, I want to bring this episode to a close, and
Okay.
we're going to do a fundamentals 2. We're going to dive into some more of that analytical stuff, some more of that foundational stuff that makes portfolio coach such an asset to me as an individual. Your insights have been fantastic today, and I look forward to following up on the next round. We got a lot more coming up. We got sectors analysis coming up. We've got more fundamentals analysis coming up. And as we go along, we're actually going to start to dissect some of the weekly performance, do some week in review stuff, so that anybody can see what's happening in Portfolio Coach on a given basis to help build that trust and why this is such a valuable asset. So Derek, thanks again for your time. Let's get you back to, you know, doing your thing so that we can continue to add value to the clients.
Hey, I appreciate it. It was great seeing you, and look forward to next time.
All right. Talk later.
Thanks. Take care. Bye-bye.
Visit get.portfoliocoach.com to get 90 days of gold subscription for free.